Hi, Cokie here with what investors need to know now. Wink, wink. That was my discovery last week. Is that the acronym "What Investors Need to Know Now" actually stands for WINK. So I'm giving y'all all a wink on what the industry won't tell you, but I might. And with that, this October series, we are focusing on what scares investors the most. What scares you the most? We're doing a little bit of a shift here today. I'm going to tell you what scares me the most. Bonds, BONDS, bonds. You heard it here. So last week we talked about 3-year bucket, and the volatility is what has been scaring markets or scaring investors the most recently. And what can you do to feel good about the ups and downs when you look at the TV at the end of the day and you see, oh, the Dow Jones Industrial sold off, 3 points or 3 percentage points. That's a big day. It's a big drop. So how does it feel? How do you make that feel better or different? You get a 3-year bucket intact. You'll have to do a refresh, go back to the video before to get a primer on that. But this week, the discussion more is on, so what goes in that 3-year bucket? Which is why I want to tell you that bonds are typically what would go in that 3-year bucket, because that's your stable choice, right? Wrong. So the average investor right now who is excited about what they've earned over the last 12 to 18 months in their portfolios, and they also got a little nervous because those returns have been so phenomenal. So they want to have this flight to quality, right? So they're looking to find some more stability, take some gains off the table, get closer to a more stable, perhaps balanced, that 60-40 balanced that most soon-to-be retirees are sort of seeking within their portfolio allocation. I'm here to tell you that scares me. What I touched on this morning in our 401 Live is that we're going to keep it real simple. And what I touched on was the 10-year Treasury bond is at 1.6%. We saw 1.2 or 1.3 just a few months ago. That's a huge increase. So keeping it simple is this. Does 1.5 or 6% sound high? Crickets, right? No, it does not sound high. Does 2.1% on a 30-year bond sound high? No, it does not sound high. So what does that mean? What that means is rates, for the most part, and if you're in my camp, and most people agree, rates only have the opportunity to go where? Up. Okay? If that happens, quite simply, bond prices, the bonds in your portfolio, the bonds in potentially your 3-year bucket, will go down. So exactly the opposite of what you want to happen with your stable, taking money off the table, shifting to a more stable, balanced portfolio. Exactly what you don't want to have happen, which is losses within equities, is going to happen within bonds. So I know that's a hard concept to understand, but all you have to think about to yourself is do I think 1.5% interest rate, do I think that's high or very low? And historically, we're at about a 40 to 50-year low there, okay? Suffice it to say. So it really, for the most part, only has the propensity to go up. So if you believe that, then one of the concepts I wanted to bring today, and I just need to hit this home to you. You're going to be savvy walking away from this conversation just with the idea of maybe you don't want bonds at all. Maybe that portion of your stable portfolio, maybe cash is good enough, despite the fact that cash or money market funds are paying very little interest. Maybe that's okay. But the savvier, the 2.0 of that conversation is have the conversation. If it's not with me, have it with your advisor. And you can ask the dirty D word. If you want to be really savvy, you can throw out the word duration to your advisor. Yeah. So what's the duration of my 3-year bucket? Or what's the duration of the bonds or the fixed income securities that you hold for me? What does this mean? Well, the duration, let's just say that is going to equal a safety factor for you. The longer the duration on the bonds, as interest rates go up, the more those bonds will sell off. The shorter, the smaller the duration of your bonds or the securities in your portfolio or in your bond portfolio, interest rates go up, the smaller amount you're going to see losses in that particular area of your account. So there's a few things for you, which is what direction do you think bonds are going to go, and what is the duration? Now, I'll take it another step further. Here's 3.0. 3.0 is I'm offering 15-minute consults. You could be one of 20 free consults this week. Click on the button. It's provided all over the website, alphavest.com. And I'm happy to have a deeper conversation with you about your 3-year bucket or about bonds or asset allocation in general. Because overarchingly, what I wanted to have in this session of what scares you the most, yes, I wanted to talk about bonds because I felt like I could get super granular, and we have. So bonds are bad right now. Make sure the duration is low. And basically, this is what should be in your 3-year bucket, is either cash or very low duration fixed income or alternative fixed income securities. But a further conversation to that is asset allocation, security selection, and really the big, almost existential or methodology conversation of buy and hold, or tactical, non-strategic, but more tactical shifting per the indicators. Which camp are you in? You know, I like to say as a planner and as an asset manager, too much of one thing is usually never a good thing. So I'm kind of that middle of the road kind of gal, kind of planner, as well as, again, asset manager. So we do both at AlphaVest. We do not only strategic buy and hold models, but we mix those in with tactical models that are shifting for the times that we're in, for the current market environment that we're in. For example, I can't speak generically to what a 3-year bucket should look like. Number one, because I don't know your risk profile. But number two, because what's in that 3-year bucket could change next month. Because that particular model is going to be very, very conservative. And what might have made sense in a 3-year bucket today didn't make sense at all 4 years ago. So that's the idea of not buy and hold, okay? You know, back in the day, someone might have said, let's put bonds in your 3-year bucket, and you could find yourself in a lot of trouble. So what's important is whether or not you subscribe to a methodology that is going to shift with current market environment. And I just have to ask the question, if it makes sense today to own small caps, I'm going to make something up. If it makes sense today to own small caps, but it made no sense whatsoever 6 years ago to own small caps, do you want to own small caps today? Yes. But do you also want to be the person who just owns them all the time, whether or not it made sense to own them today or 6 years ago? I say no. I call that lazy. So today's conversation, the higher, easier level is bonds scare me, and you should also be scared. And what that dribbles down into is that currently looking at or constantly looking at what current market value, current market environment dictates should be in your portfolio. Should you be doing that? I mean, if you can make it your full-time job, maybe. I think the key is having an advisor who subscribes to both methodologies. You know, one of the things I think I touched on this morning in live is that there is no doom and gloom with us in our practice and how we manage money. It's no, run for the hills because we think, securities are overvalued, stocks are overvalued, and they're going to sell off. We're not a doom and gloom shop, because guess what? The way we manage money, by looking to where the trends are and where money is to be made and what securities are going up, could be gold, could be stocks, could be bonds. So we're agnostic as to whether or not we're going to be investing in the stock market. And we believe you can make money in all types of markets. So whether or not the stock market is overvalued is irrespective as to whether or not you can continue to make money and or preserve what you've grown. So, the bottom line is I do think that every investor should be looking at a nice, healthy blend of your buy and hold ETFs that are your stable labels that you're going to own forever, mixed in with a tactical overlay of when, the temperature on the market gets a little hot, maybe you do take some off the table. And when your 3-year bucket, it makes sense to own 30-year bonds, because the duration is low. You own 30-year bonds in your 3-year bucket, and you get a nice, let's say, typically 3 to 5% return. That's not the current market we find ourselves in. So I hope I wasn't misunderstood. No one should own a 30-year bond currently, in my opinion. But again, the bottom line is I'd love for you to engage further, and I can give you some, something more meaty that perhaps you can bite off and chew that's specific to you, but we need to do that one-on-one. So feel free to click on my Calendly link on the AlphaVest website and see if you can grab one of those 20 free consults. Would love to engage with you on that. And furthermore, what I would say is download the latest edition of Liberated Investor. So our 3rd edition published in January of this year. And this strategy I talk about is very well delineated and graphically depicted in a very easy to read 13-page ebook. It's free. It's my gift to the industry and to investors at large. So I hope you'll download that today. I know it'll help you. It's really meant to help demystify the games that Wall Street plays. There's 4 things you can do as a liberated investor. All 4 steps are in there. One of them talks about active investment management, a dynamic approach to managing your assets, which simply takes into account, again, buy and hold, and tactically what's happening. Is the risk on the field appropriate for where my portfolio currently is? So with that, thank you for joining me for this edition of What Investors Need to Know Now. We'll be back at it next week, Monday morning, 4:01 live on Facebook, Cokie Perfect Day 411. Again, that's at Cokie Perfect Day 411. I'll give you a little snippet there as to what Wink will be all about next week as we continue the October series of What Scares You the Most. Thanks for joining us, and I look forward to your feedback, engagement, and to connecting with you soon. Take care and make it a perfect day.